a lot tonight about the key terms of technical analysis. Now let's look at some of the individual charts that many of you find fascinating, even as some of the patterns, they almost sound silly, as if they're mimicking letters or geometric shapes or even body parts. I learned not to ignore one of the most simple but by far the most reliable patterns out there, the dreaded head and shoulders pattern. When my charitable trust bought Alcoa in the low teens in 2010, it ultimately took a giant bath in red ink because of that ill-informed, or could I just really say maybe early buy? Remember, I like to do mea culpas on the show. I like to show you what I did wrong. You can learn from my mistakes. We had correctly become enamored of the great work CEO Klaus Kleinfeld had been doing at Alcoa, making it less dependent on metal itself, more on proprietary forms of aluminum, something it solidified when it announced it would split into two separate companies. Here, why don't you take a look at Alcoa, okay? This had enjoyed a healthy run from the winter of 2010 right up until February of 2011, rising from $13, nice rise, right, up to 17 as its earnings trajectory seemed to have finally turned around. Not long after the stock hit 17, it took a quick dive back to 15. No reason I could discern. Then it quickly reversed and went right back to 17. And then went up to 18 on the eve of the quarterly report. I thought the quarter, when it was announced, was a fine one, beating both the top and bottom lines. Most of the time, that's all you can ask for. What worried me, though, was that after an initial positive reaction, the stock then dropped down to 16 and change on the news of that better-than-expected quarter. A few days later, oh, there we go. It's back to 17, and I felt almost vindicated, right? I mean, come on. Now ready to go back and take a challenge at 18 level. So I went and bought more. Right there. Well, could I have been more wrong? I don't think so. Because that $17 to $15 dive represented on the chart as point A and B, then follow the run to C, 18, back to 16, D, finally 17, E. You know what that is? That's a perfect head and shoulders pattern. Yeah, just like a human's head. That is it. That is the most frightening pattern in the entire chart book, and Alcoa had traced it out just when I thought we were out of the woods. What was happening during that period that the head and shoulders pattern flagged? Europe and China began their slowdowns, and aluminum quickly came into glut, thereby stunning the turn that Kleinfeld had worked so hard to execute. He could control his own company, but not the price of the commodity itself. Still is aluminum. Over the course of the next few years, Kleinfeld was able to reinvent Alcoa to be much less dependent on the commodity, to rally well off its lows. But that came only after completion of the brutal head and shoulders pattern from a few years before, one that cost the trust quite a pretty penny. Remember again, mea culpa. One of the things I admire about technicians is their intellectual consistency. If a head and shoulders pattern signals trouble ahead, an inverse head and shoulders pattern signals the opposite, a real chance for glory. At the beginning of January 2013, lots of people thought the economy was taking off, and investors were running for the classic food and drug stocks, the ones you don't need a strong economy. And they were headed toward the cyclicals. Yeah, Caterpillar, Cummins, United Technologies, you know. The kind of rotation, that kind, is usually the death knell for stocks that typically go higher only when the economy's slowing. However, Tim Collins, on an off-the-chart segment, said, you know what, Jim? You ought to have to take a hard look at Pfizer, because its stock was tracing out a reverse head and shoulders pattern. The world's largest pharmaceutical company would be precisely the kind of company that I would shun. I would normally never touch this thing when the economy's speeding up. But if you take a look at this chart, you can see that Pfizer traced out a left shoulder as it rallied through the month of October and then started declining aggressively. Okay, in November, the stock bottomed to form the head, and then in December, it caught a rally, and then a pullback to create the right shoulder. The key with this pattern is the neckline, the line that connects the head to the two shoulders. When a stock breaks out above that line, it tells the technician that you were about to witness a big, big, big move. Pfizer's neckline was at $25.80. And Collins predicted that if it could take out that neckline, it could be in for a monster run. Given that money was pouring out of the staples and drug stocks headed for the industrials, I was confounded by this bullish reverse head and shoulders pattern. I didn't trust it one bit. I mean, come on, I'm like king of rotations. I knew it was a bad stock. But Collins said rotations, smotations. You had to close your eyes and buy the stock because something big was going on that could make it buck the market's prevailing trends. I think it was inconceivable. Sure enough, he was right. I was wrong. The stock almost instantly jumped more than 10% after Collins told me to buy it with both hands. What caused the move? Soon after Collins flagged this bullish reverse right here, the reverse head and shoulders pattern, The huge drug company decided to spin off its animal health division. It was a shocker into a new and publicly traded company called Zoetis, in a move that ultimately created $15 billion in value. Who knew? The chart did. Here's the bottom line. Patterns matter. When you see a head and shoulders pattern, no matter how confident you might be in a situation, don't take any chances. Sell, sell, sell. At least some of it, please. And when you see reverse head and shoulders developing, even if it makes no sense when it comes to which stock it is happening to, you got to consider buying some. That's how powerful these moves are. And the chart work on these two patterns is vindicated far more often than the skeptics would ever think possible. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.